Hello, very good morning and happy Friday to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 21st of March 2025. So as usual, before we start today's gist of Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the intraday movement of those broad-based cross-asset classes, ranging from the major stock indices, the FX market, some of the key commodities that we cover on a daily basis, gold and as well as West Texas crude oil, and most importantly, the relevant news flow or economic event that influence this movement. So yesterday, there actually one particular economic event that I want to highlight will be the Bank of England monetary policy meeting. So as it came in within market expectation. So the Bank of England actually left interest rate unchanged at 4.5%. That was stand cut. Okay, after they stand pat after their third interest rate cut in the previous meeting. Where they reduced their key policy rate by 25 basis points from 4.75%. So the rationale for them to actually maintain the interest rate, or I would say their policy key rate in UK, was due to the uncertainty surrounding US current White House aggressive trade tariffs policy. So it's almost pretty much in line with the tonality that was actually introduced by the prior FOMC meeting on the 19th of March. All right. So what you could see over here is that there are 9 committee members. So actually only one of them chose to actually reduce interest rate to 25 basis point in UK. So what you could see over here is that actually came in with within market expectation. So even though it was kind of a hawkish stamp pad scenario, but however, hawkish stamp pad interest rate decision by Bank of England, but however, the dollar has started to strengthen against the sterling yesterday. All right, so you see a slight uptick in the dollar's sterling rate. All right, so later we have covered the short-term intraday technical outlook. So we know that the very interesting we call it conjunction between fundamentals and technicals is that in the very short term, if we start to see over optimism in some aspect of the technical factors on a particular so-called highly tradable instrument like in the FX market, there could be a potential counter trend movement. So what I mean on stress over here is that yes, Bank of England yesterday chose to stamp at its interest rate decision. From a fundamental perspective, it should actually strengthen the sterling against the USD. Why? Because they decided to not cut interest rate and introduce a kind of a hawkish tilt to their monetary policy statement, stating that due to Trump's aggressive trade tariff policy that may induce sticky inflation pressure back into UK economic, we call it a picture. But however, why did the sterling actually drop against the USD? That means instead the sterling dollar depreciate against USD yesterday was likely driven by short-term technical factors that has hit what I call overbought condition. So later I'll share with you more when I cover the technical elements chart of the sterling dollar. All right, so and another particular event that has taken shape today is more pertaining to the dollar yen, what you could see over here. So that is actually related to Japanese inflation. All right, inflation figure for the month of February. So in Japan, there is actually a way they kind of differentiate the term slightly different against the other major economic like the US or the UK and the rest of the world. They do have a core inflation, which is inflation rate excluding food and energy. All right, so this core inflation rate over here is not really it's only including excluding energy, but didn't exclude the food. So even though the core inflation rate dipped down slightly than dip down slightly than was previously printed in the month of January at 3.2%. It actually also rose 1 basis point higher than what market expecting at 2.9%. But most importantly, the Bank of Japan is watching the core inflation rate, which is the rate that is excluding food and energy, which actually rose by 1 basis point higher from 2.5% that was printed in the previous month of January. So if you look at the trend of the core inflation, which is the key metrics that Bank of Japan officials choose to watch us to actually guide its future monetary policy decision. So let's look at the trend. Okay, yes, this is one. So this is the core inflation trend. So at 2.6 level, this is the highest level since March 2024. So it's almost a 1-year high over here. So if you look at the 10-year trend of the chart, oops, it's hang. Okay, give a minute. I'm not sure why you're not picking up. Okay, I'm not sure why is it not showing up. But nevertheless, from the start of this year, it starts to pick up rather aggressive. There's a kind of a V-shaped recovery in the core inflation trend of Japan, which is latest figure just released this morning for the month of February is at 2.6%, 1 basis point higher than 2.5% that was printed in January. And given the latest figure of 2.6% year-on-year increase in the month of February, this is the highest rate of increase in core inflation for Japan since almost a year ago. So that actually is in line with Bank of Japan outlook to continue its gradual interest rate hike policy in Japan. So what you could see over here is that yes, there's actually a slight bump in the dollar yen over here, the dollar yen rate, but it still remains below our key resistance level at 49.10, which I highlighted earlier yesterday in my short-term pivotal resistance level. All right, now back to what we are seeing in the major US stock indices. So for the major US stock indices, all of them actually closed in the red yesterday. So what you could see is that initially there was a big jump over here at the start of the intraday, first hour of the intraday cash market session for the US stock market. Then thereafter, the returns, the intraday gains yesterday starts to dwindle downwards. So market has now starts to pay more close attention to this ongoing, number one, stagflationary risk environment that's still intact. Do not forget the rally that was seen yesterday and the day before is seen yesterday on 19th of March. FOMC meeting is more or less induced by Fed Chair Powell, comforting word of inflation is transitory in nature due to he do not see it as rather sticky, even though the US Federal Reserve dot plots show increase or upward revision in inflation forecast for this year due to Trump's so-called aggressive trade tariffs policy. So market seems to be calling it as a bluff yesterday. So they tend to actually, what you see is more of a profit-taking scenario after that spike up. All right, so I mentioned earlier on is that whatever rebound that we see so far in the major US stock indices, given my short-term intraday technical outlook on the US Wall Street 30 that representing the Dow Jones Industrial Average, as well as the Nasdaq 100 is more corrective in nature rather than the start of a impulsive up move sequence that could start to see fresh all-time high. All right, so later I'll talk more about that when I cover the intraday technical outlook chart of these indices. All right, so what I could see is that the SPX ended down negative 0.22%, the Nasdaq 100 almost the same magnitude, down negative 0.3%, the Dow Jones almost unchanged, the Russell 2000 is fair the worst, down negative 0.65% over here. All right, so with that, that sum up the first session of today's intraday daily technical outlook. One more thing I want to highlight over here is the West Texas crude oil continues to actually rally. All right, within our expectation, and right now it's actually broken above the 20-day moving average. So at the start of this week, we do have a bullish bias for a counter trend rally in the West Texas crude oil that is playing out within our expectations. So later I'll highlight what are the key levels to watch again late in the later part of the intraday technical outlook for West Texas crude oil. So the reason why West Texas crude oil is bouncing out right now is due to the fact that there could be more ongoing uncertainties regarding about a prolonged ceasefire deal between Israel and Hamas, and also that that's potentially see a bit of supply shock in the Middle East region, and also this potential upcoming stimulus measure coming out from Chinese top policymaker that could actually create a positive internal demand feedback loop for oil demand in China that is now playing out on the West Texas oil price action. All right, so without further ado, now let us now jump straight to the intraday technical outlook on the FX market. So before we jump into the intraday technical outlook on the FX market, I want you guys to take a look at what's happened on the FX market space right now, based on the 5-day rolling performance of the dollar against the major currency as of today we are speaking. So yesterday I also did highlight, do take a look out for the dollar strength coming back into the Aussie dollar, which is actually materialized. So what I could see over here is that the dollar right now is strengthening the most against the Aussie dollar. So one of the reasons why it's taking shape over here is also due to this external growth uncertainty surrounding due to Trump's aggressive trade policy. So do not forget, Trump wanted to do a global reciprocal trade tariffs against all major trading partners with the US. All right, so that likely to be enacted on the 2nd of April. All right, so with that, the Australia dollar being a proxy of a high because there's a high beta currency, a proxy of economic growth. That means, i.e., if economic growth condition continues to soften, the Aussie dollar tends to weaken. That means, i.e., the dollar tends to strengthen against the Aussie. So this is the reverse of what we are seeing right now. And with that, we also start to see the dollar picking up against the euro dollar as well, and also starts to pick up against the sterling dollar, the Swiss franc, and the Canada dollar, but at a slower pace. Right, so without further ado, now let's jump straight to the individual technicals, starting with the euro dollar. All right, so before that, let me expand my screen. All right, so on the chart of the euro dollar, what you could see over here, we flipped to a bearish bias yesterday using 1.0940 slash 1.0970 as my short-term pivotal resistance level. Price action tumbled as expected over here, and it hit our first, almost hit our first support during the start of the US session before staging a minor bounce. So what I would do over here is that I would have a first resistance level at 1.0870, but I don't want to tighten my short-term pivotal resistance to be so tight at 1.0870 because it hasn't staged a bearish breakdown below 1.0810, unless during the European session later it have a bearish breakdown below 1.0810, then I could potentially shift down the short-term pivotal resistance to 1.0870. So still maintaining the 1.0940, 1.0970 as my short-term pivotal resistance level. Still maintain that intraday bearish bias on the euro dollar for today. Below 1.0810, potentially sees the next near-term support coming in at 1.0730, which confluence with the 200-day moving average and as well as the 20-day moving average, I think as a similar resistance level at 1.0730. On the flip side, an hourly close above 1.0970 will invalidate today's intraday bearish bias to see a squeeze up towards the next intermediate resistance at the 1.10 figure level and even 110.50. So that's for the euro dollar, still maintaining a intraday bearish bias using 1.0940 slash 1.0970 as the short-term pivotal resistance for today. Next up will be the sterling dollar. So sterling dollar, I want to highlight on the daily time frame chart for you guys to give a better view of the chart. So what you could see over in the daily time frame chart, we start to see three bearish candlesticks that has starts to form since 18th of March. 19th of March, it starts to form a hanging man, and this hanging man, it have a that bearish price action candle follow through at the end of yesterday. So at the end of yesterday is also a key event. It corresponds with the key event, which is the Bank of England monetary policy decision, right below this 1.3040 resistance level, which is the which is the medium-term swing high area of 30th of October and 6th of November that got rejected previously. And if you do the FIBO retracement of that previous medium-term downtrend from the high of 26th of September 2024 all the way down to 13th of January 2025 low, that kind of corresponds slightly below the 76.4% FIBO retracement level. And interestingly, with these three bearish candlestick formation, you also coincide with a kind of bearish divergence that's being also flashed out on the hourly RSI, where the hourly RSI start to shape a lower low. and it starts to lower high, pardon me, not lower low, lower high, and it starts to exit from the overbought level. All right, previously the price action starts to inch upwards slightly. So given this daily technical elements that has turned bearish on the sterling dollar. So with that, given that technical analysis pay more close emphasis on the higher time frame chart, on the intraday for today, we will flip to a intraday bearish bias on the sterling dollar using 1.3025/130.40 as my short-term pivotal resistance level. We flip to an intraday bearish bias. First near-term support level to watch will be 1.2910, which is very closely to the which is the minus swing low of 12th of November and 14th of November. A breakdown below it may expose 1.2865 next, which is coming very close to the 20-day moving average as well. However, a price action push up and hourly close above 130.40 short-term pivotal resistance level may invalidate today's intraday bearish bias to see a squeeze up towards 1.31 figure level and even 1.3170 next. So i.e. given the just highlighted bearish element on the higher time frame daily chart on the sterling dollar, we will flip to a intraday bearish bias for today using 130.25/130.40 as my short-term pivotal resistance on the sterling dollar. Okay, with that, let us now focus on the Asia Pacific currency against the dollar, starting with the Aussie dollar over here. So the Aussie dollar plummeted as expected after almost retesting the 64 medium-term pivotal resistance on Tuesday, and also it staged a bearish breakdown below the minor ascending trend line from 4th of March, and now it's also broke down below the 20-day moving average. And during the Asia session today, it attempt to actually retest it, but thereafter it shaped a bearish reaction, all right, by forming a lower high. All right, this high lower than this high. So using the 20-day moving average as my first key resistance level for today at 63.10, but it hasn't broke below our first near-term support where it made yesterday at 62.80. I do not want to tighten my short-term pivotal resistance to be so tight at 63.10 unless we have an hourly close during the European session below 62.80. Then I could tighten the short-term pivotal resistance to 63.10. So still maintaining at 63.30, which is my short-term pivotal resistance for yesterday. Still having that intraday bearish bias on the Aussie dollar below 62.80 exposes 62.40 next, and if 62.40 can't hold, potentially it may start to see down, breaking down below to retest the 28th of February minus swing low and 4th of March minus swing low that is coming to act as the next near-term support level at 61.90. All right, let me put it in writing, 0.6190. Okay, however, if we start to see a very sharp rally and a push up with an hourly close above 63.30, today's intraday bearish bias will invalidated to see a squeeze up to revisit 63.60, a breakout above 63.60 re-exposes the medium-term pivotal resistance at 64 figure level, which is this dotted gray line here. So this dotted gray line is in fact a very key inflection level, which is the former major ascending trend line from 30th October 2022 low, now turns into a key inflection pullback resistance level that got rejected on the 20th of February and most recently on 18th of March. Right, so that's for the Aussie dollar. Moving on, next lastly will be the dollar yen. So the dollar yen, we in our it actually staged a bounce, but this bounce so far in the last 2-3 hours as we are speaking managed to stall at the 49.10 Titan short-term pivotal resistance that we highlighted yesterday, and also this former minor ascending trend line from the low of 11th of March now turns into a pullback resistance level as well. So with that, if we start to see the hourly RSI also correspondingly starts to actually react off a parallel descending trendline resistance as well. So no change, 4910 will be my short-term pivotal resistance to maintain my intraday bearish bias on the dollar yen. First near-term support level to watch will be on yesterday's minor swing low area that got tested but survived during the start of the European session at 14820. Only a breakdown below 14820 may see further weakness towards 14750. However, if price action starts to see a squeeze up with an hourly close above 14910, today's intraday bearish bias will be negated to see a retest right above 150 figure /50, which is the upper limit of this medium-term descending channel that is still in place since the high of 10th of January. Right, so i.e. still using the tighten short-term pivotal support that we have for yesterday, 14910, to maintain its intraday bearish bias on the dollar yen. But price action got to break down fast below 1480.20, 148.20 to see a much more higher probability weakness that is being triggered back into the dollar yen. All right, with that, that sum up the intraday technical outlook on the major US dollar pairs. So let us now turn our focus to the major stock indices, starting with the Hong Kong 33, i.e. the benchmark representing the Hang Seng Index. So the Hang Seng Index, let's take a look at the daily time frame chart. All right, so the daily time frame chart on the Hang Seng Index on Tuesday, on Wednesday itself, it almost hit the resistance level at 25,080, and thereafter it actually shaped that pullback. Very interestingly, upon hitting the resistance at 2580 yesterday, it starts to shape a very clear bearish divergence. All right, a very clear bearish divergence where price action starts to trend higher high over here. Okay, but there is a bearish divergence that is being depicted on the daily time frame chart. So given the fact that its higher time frame chart is now showing signs of bullish exhaustion, I'll be not so convinced to maintain my intraday bearish bias that I have for yesterday. So in fact, right now it's actually testing the key mid support level that I highlighted, 23,290, that we highlighted on the Hong Kong 33. So with that, and also very close to the 20-day moving average, and as well as the upper limit of this, the lower limit of this medium-term ascending channel that I drew from the low of 10th of January. So given the fact that because of that bearish divergence that is being depicted on a higher time frame chart on the daily RSI, I'm not so convinced right now that to maintain my intraday bullish bias on the Hong Kong 33. So with that, I will flip to a neutrality stance. So neutral between this 23,000, okay, give me a minute, 800, 830, pardon me. So right now it's actually testing below it already, 23,830 and 24,510. So unless we have, because while we are speaking right now is 11:24 a.m. Singapore time. So unless we have an hourly close below 23,830 at the 12:01 mark PM mark later during the Singapore in Singapore time, potentially then that could ignite a minor corrective decline sequence, exposing the next near-term support level at 23,250 for today. A breakdown below it may see further weakness towards 22,470 next. However, on the flip side, if we have a recovery with an hourly close above 24,510, which is the upper neutrality zone for today, then the Hong Kong 33 may revive its impulsive up move to retest 25,080 in the first step. So given the fact of the bearish divergence that is being seen on the daily RSI chart on the Hong Kong 33, that represent a medium-term bullish exhaustion condition, we will not have a strong conviction to maintain the intraday bullish bias on the Hong Kong 33. Therefore, we flip to a neutrality stance between 24,510 and 23,830 for now. Right, now onward next will be the Japan 225 representing the Nikkei 225. So the Japan 225 managed to actually survive at the 20-day moving average and stage the rebound, and also continues to trade within this minor ascending channel that is in place since 11th of March 2025 low. So still no change. This potential minor corrective rebound phase still continues to remain intact on the Japan 225, potentially retracing some of its earlier weakness to shape a mean reversion rebound to revisit back the 38,325/38,490 next near-term resistance level zone, which is correspond to very closely the 50-day moving average, and as well as the 200-day moving average as well. So using 36,610 as my short-term pivotal support for today, still maintain the intraday bullish bias for this potential ongoing corrective rebound sequence to play out on a minor time horizon. Next near-term resistance zone to watch will be at 38,325/38,490. However, an hourly close below 37,610 invalidate today's intraday bullish bias to see a slide to expose the next near-term support at 37,200. Okay, so that's for the Japan 225. Next up will be the German 30, representing the German DAX over here. So the German DAX yesterday plummeted, but managed to survive at the short-term pivotal support level, which I highlighted, and also close to the 20-day moving average as well. So the hourly RSI now starts to print a series of a higher low right above after exiting from its oversold level yesterday. So with that, we still maintain the intraday bullish bias on the German 30 using 22,120 as my short-term pivotal support level, because yesterday it managed to have a hourly close above it. It didn't have a hourly close below it after the test of it yesterday. But however, short-term resistance level will be much lower for today. So today's intraday resistance level to watch in this potential bullish bias basis on the intraday basis for German 30 will be at 23,180. That's my first resistance level to watch. Okay, followed by 23,360 level. Okay, let me confirm. Okay, 23,360. All right. So two resistance level to watch, 23,180 and 23,360 on an intraday basis. But however, if price action have an hourly close below 22,120, today's intraday today's intraday bullish bias will be invalidated to see the further slide of this ongoing minor corrective decline to expose the next near-term support level at 22,740, which is the former minor swing high of 12th of March, and as well as 13th of March, and very closely the lower limit of this ongoing medium-term ascending channel from the low of 13th of January. However, a breakdown below 22,740 may potentially start to see a kind of a more multi-day corrective decline sequence to expose the next near-term support in first step at 22,440 next. So i.e. still watching very closely the 22,120 short-term pivotal support level in order to maintain today's intraday bullish bias, given that we have a higher low that is being flashed out on the hourly RSI after it hit the oversold region yesterday. But near-term resistance level will be tightened today. First resistance level at 23,180, followed by 23,360 next. Okay, on the German 30. Next up will be the major US stock indices. So on the US Wall Street 30, which is the Dow Jones Industrial Average, we maintain that intraday neutrality stance. So what I could see over here is that there's some form of exhaustion that's being seen. So what I could see at the start of yesterday's US session, it rallied, print a higher high over here, a higher high on the price action. But the hourly, oops, where was it? Okay, let me remove this. Okay, it retested the upper limit of the neutrality zone, also the 200-day moving average. But however, the hourly RSI printed a lower high, okay, upon hitting the overbought level. So what I could see over here is some form of exhaustion, bullish exhaustion that's been seen despite yesterday's push up to retest the 200-day moving average. So with that, we still maintain a neutrality stance for today. So neutral between 42,490 slash 40. Okay, so it's basically 42,250. Okay, let me put it in writing, slash 490. Okay, with the lower limit of the neutrality zone at 41,450. Unless we have an hourly close below 41,450, then potentially we may trigger off the start of an impulsive down move sequence within this medium-term downtrend phase that is still intact since the high of 31st of January to revisit the 14th of March swing low area at 40,665. All right, so still maintaining that intraday neutrality stance between 42,250 slash 490. Lower limit we are watching will be at 41,450 for hourly close below it, in order to increase the odds of the start of an impulsive down move sequence, given the fact that the hourly RSI has started to flash out a bearish divergence, indicating yesterday's push up is a lack of momentum. So that's for the US Wall Street 30. Key levels to watch out for today. Onwards, next will be the Nasdaq 100. So given the fact that the Nasdaq 100 also failed to actually stage a breakout above 19,910, but managed to survive at the 19,580 short-term pivotal support level that we highlighted yesterday, where it tested 2 times at the start of the US session and towards the middle part of the US session. So with that, given the fact that the hourly RSI has started to print out a lower high, a series of lower high over here, representing a lack of upside momentum. We will now we will now have a lack of conviction to maintain that intraday bullish bias that we have yesterday. So we'll flip to a neutrality stance instead for today. So neutral between 19,910 and the lower limit will be 19,580. So we're watching very closely the 19,580 lower limit. A breakdown with hourly close below 19,580 may trigger off the start of another impulsive downward sequence within this medium-term downtrend phase that is still intact since its 18th of February current all-time high area, exposing or revisiting the minor swing low area of 11 of March and very closely the 14th of March at 19,125 next. All right, so given the lackluster observation and with a series of lower high that is being flashed out on the hourly RSI, depicting the lack of upside momentum, we are now not convinced to maintain yesterday's intraday bullish bias. Will flip to a neutrality stance on the Nasdaq 100 between 19,910 and 19,580, and we are watching closely the lower limit at 19,580. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on the major stock indices. All right, so with that, let us now focus our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, price action continues to evolve within this minor ascending channel that is in place since 11th of March over here. So with that, price action now it starts to actually stage a pullback from this minor ascending channel over here. And what we could see at this point in time, the hourly RSI has started to stage a bearish breakdown. Okay, it starts to stage a bearish breakdown from its parallel ascending trend line that was previously in place since the low of 38th of February. So with this bearish breakdown that's being seen on the hourly RSI, giving a bit of bearish pre-signal on gold XAU/USD. So with this bearish breakdown that's being seen on the hourly RSI, we're now not so convinced to maintain that intraday bullish bias on gold XAU/USD. So with that, we'll flip to a neutrality stance for today. So perhaps it may start to trade in a sideways fashion for now on an intraday basis. So neutral between 30.17, which was our yesterday's short-term pivotal support level, and the current all-time high area at 30.58. Okay, so I repeat again, given the bearish condition that's being flashed out on the hourly RSI right now, we are not convinced to maintain the intraday bullish bias that we have for yesterday. So we'll flip to a neutrality stance for today. So neutral between 30,058 and the lower limit of the neutrality zone for today will be 3,017 or 3017. Okay, on gold XAU/USD. So lastly will be the West Texas crude oil. So like I mentioned, the West Texas crude oil continues to stage a bounce and hit our first resistance level at 68.80, and right now it's trying to stage a minor pullback and trading above the 20-day moving average as well. So using the 20-day moving average as my first support level coming in. Oops, let me put it in writing again in green. Okay, will be at 68.20, but I don't want to target it so tight because it hasn't have a clear hourly close above 68.80 yet as we are speaking. So unless you have an hourly close above 68.80, then I could tighten the short-term pivotal support level to a tighter level at 68.20. So 68.20 being the first support level that could see a bit of minor pullback, given that the hourly RSI has started to exit from its overbought level that was made yesterday during the US session. So as long as this minor pullback didn't surpass below 67, 66, over here, a very clear graphical former minor swing high of 20th of March now turns into a pullback resistance after that very short rally that was being induced on the US session yesterday, at the start of the US session yesterday. So using a slightly higher 67, 66 short-term pivotal support level versus the previous pivotal support that was at 66.45. We will maintain that intraday bullish bias for this ongoing corrective rebound phase on West Texas oil. Next resistance level to watch will be 69.50. Above it, potentially see 70.80, which is the minor swing high area of 28th of February and 3rd of March. Only a breakdown with an hourly close below 67.66 will invalidate today's intraday bullish bias to see a choppy downward drift to revisit the minor swing low area of 19th of March and 14th of March at 66.45. Breakdown below it, revisit the major range support zone at 65.70/65.40. So that sum up the intraday technical outlook on West Texas oil and as well as the major cross asset classes. So before we go, let's have a quick look at the calendar. What are the key events and data to look out for today? So for today, one key event to look out for pertaining to the US stock market will be, we call it the triple witching option expiry. So it's close to a 4 trillion notional value that's going to be expired on 3 different derivative asset classes, all tying to the US stock market: stocks, individual stocks, stock indices, and exchange traded fund. So with this triple witching expiry date, there could be two-way volatility that may be seen on the US stock market for today. So that's why I do also flip to a neutrality stance on the Dow Jones Industrial Average, which is the Wall Street 30 and the Nasdaq 100, which I highlighted to you earlier. And this is one of the key events to look out for, but more pertaining to the US stock market, which is a triple witching option expiration for today, where all 3 different asset classes in terms of US equity, individual stocks, the major stock indices, and as well as ETF exchange traded funds option are set to expire today at the middle part of, at the start in the middle half of the US trading session. And in terms of economic data, what are the data to look out for during the European session? In the European session, it's rather quiet today. There's no key data to mention. For those who are more looking at the dollar CAD and the Canada dollar crosses, we do have Canada retail sales that is up at 8:30 p.m. Singapore time. All right, and also at 11 p.m. We do have Eurozone consumer confidence flash data for the month of March over here at 11 p.m. Singapore time, and that potentially sum up today's daily dose of market insights. So with that, I'm Kelvin here signing off. I wish you all a great and restful weekend, and we shall speak again on next Monday. Thank you.